Well, the exciting highlight, well, maybe I'll start off with the broad theme, and that was over 120 years. Surprise, surprise, equities is the best returning asset class. So global equities returned 5.2% per annum in real terms over the last 120 years, and bonds returned 2% in real terms. But the big news for Australians is that the Australian stock market won the gold medal. So it is the best returning stock market in US dollar terms in the last 120 years, followed by the US, South Africa, and our friends across the ditch, New Zealand, in fourth place. So the Australian stock market has returned in Aussie dollar terms 6.8% per annum in the last 120 years. And the bond market, the Australian bond market, has returned 1.8% in Aussie dollar terms. So what stands out about Australian returns in the Australian stock market is it did it with the lowest volatility, which is surprising. So the Australian stock market has the lowest standard deviation of all the stock markets around the world. And it's surprising because of the predominance, at least historically, of mining companies, which are cyclical. So you'd think our market would be more volatile, but the numbers don't bear that out. The other interesting thing about our market, and global markets in general, like global equity markets, is how rare a negative decade is. So if you look at the dispersion of returns in particular decades, a negative decade where you invest at the beginning of the decade and you theoretically sold at the end is extremely rare. So the worst decade was the decade ending 1978. So if you invested in 1968, sold in 1978, you would have had a negative return of 5.6% per annum. The best decade was the decade ending 1928. And if you invested at the beginning of 1918, so just post the First World War, the return would have been 16% per annum over 10 years. So the message is that if you happen to choose the wrong decade to start investing, that at least in the short term you might go backwards, but it's extremely rare. But the longer you hold, the more likely your return averages out to a positive return. So that's very clear. So even 10 years, if someone happens to choose a bad decade to start investing, if you hold it beyond 10 years, the likelihood of a positive return is extremely high. So the interesting thing is that the top 5 or 6 markets in terms of return were those markets that had the best dividend growth. In terms of the actual split between dividends and capital growth, clearly for Australia, dividends were more than half of the return. But in the US, a very different market. They're less concerned about dividends over there. So dividends aren't a big issue for them. They're all about growth. So the big majority of the returns in the US were from capital growth. And that's probably got a lot to do with franking credits, encouraging dividend payments, certainly since franking credits arrived some decades ago.